Chapter 12, Taxes and Regulation. Section 4, Compliance. Compliance means following the rules tied to your investing activity, and it is a core part of investing responsibly, not just paperwork. That includes tax laws, account and transaction reporting requirements, and market conduct rules, with specific duties depending on whether you are an individual investor or a financial professional. When everyone follows the rules, it supports fair markets, protects investors, and helps make sure taxes are reported correctly. For most individual investors, compliance mainly means reporting investment income accurately, including gains, losses, dividends, and interest, and sometimes filing extra forms for certain foreign accounts or assets. For firms and financial professionals, the responsibility is much broader. They also have to follow disclosure rules, monitor for anti-money laundering concerns, make suitable recommendations, and keep clear records of client activity and communications. A useful way to remember the main regulators is by what they oversee. The IRS handles tax reporting and tax compliance. The SEC oversees securities markets and federal securities laws, and FINRA focuses on how broker-dealers operate and behave. Knowing that MAP makes forms, disclosures, and account rules feel much more logical, and outside the US, regulators like the FCA in the UK and ASIC in Australia play similar roles. Non-compliance is rarely just a simple fix. One missed rule or deadline can quickly escalate from fines and interest into amended returns and a lot of extra paperwork. In more serious cases, it can trigger audits, account restrictions, or even legal consequences, which is why careful record keeping and accurate reporting matter so much. Think of compliance as a simple yearly cycle. First, understand which rules apply to you based on what you owned, sold, earned, and where your accounts were held. Then gather your statements and tax documents, complete the required forms, and finally file, pay anything due, and keep organized records so deadlines and follow-up questions are easier to manage. Different investing activities connect to different tax forms, so the goal is to match each transaction to the right filing path. A broker usually sends Form 1099-B to report investment sales. Then the investor uses Form 8949 to list those sales, Schedule D to total gains and losses, and Form 1040 to report income. If foreign accounts or foreign taxes are involved, separate rules may apply, including FBAR reporting and possibly Form 1116 for a foreign tax credit. Good compliance starts with complete records, because broker statements, trade confirmations, dividend and interest records, and foreign account details help prove proceeds, cost basis, income, exchange rates, and account balances. It also means tracking deadlines carefully, since some required reports are separate from your regular tax return and may be due on different dates. As a general rule of thumb, keep records for 3 to 7 years, because missing paperwork or missing a separate filing deadline is a common source of trouble. Maria's example shows how one investment decision can create several reporting duties at once. Her $5,000 stock gain starts with Form 1099-B, then flows through Form 8949 and Schedule D onto her federal return, while foreign dividends must be converted into US dollars, and any foreign tax paid may support a Form 1116 credit. Because her London account went over the $10,000 equivalent threshold, she also has to file an FBAR electronically using FinCEN Form 114. Many compliance mistakes are avoidable. People forget to report foreign accounts, mix records between accounts, or assume small gains are too minor to matter. In reality, even small sales are often reported by brokers, so omissions are easier for tax authorities to catch. Keep each account's records separate and update cost basis for events like stock splits, mergers, spin-offs, or reinvested distributions, because every basis change can affect your taxable gain. Before you file, do a quick checklist. Did you sell any investments, receive dividends or interest, have foreign accounts or foreign income, and do all your records, tax forms, and deadlines match? That simple clipboard-style review can catch missing items before you submit, helping you avoid penalties. Accurate reporting may feel administrative, but it's a practical investing skill because it helps you understand the tax and legal impact of your decisions.